The Reserve Bank today is increasing the official cash rate by 0.25% to 2.75%. This is needed to help contain the rising inflation pressures associated with the strong economic expansion that is becoming increasingly broad-based. Several factors are driving this expansion. Our terms of trade are at a 40-year high. Dairy prices are up 43% over the past 12 months, and prices of most of our other commodities are strong. The decline in policy rates to a 50-year low has stimulated demand. Residential investment is up around 40% over the past 2 years, and investment in Christchurch reconstruction is expected to be $1.5 billion higher than last year. And the rapid increase in net immigration over the past 18 months is boosting housing and consumer demand. Business and consumer confidence is at multi-year highs, and hiring and investment intentions are increasing. We are seeing some moderation in the housing market. Loan-to-value restrictions are starting to ease pressure, and rising interest rates will have a further moderating influence. However, the rise in net immigration flows are adding to housing pressures. Inflation pressures are starting to increase and are expected to do so over the next 2 years. We want to keep inflation expectations contained. In order to do this, we need to raise interest rates to a level where they are no longer adding to demand. How much and how fast we need to raise rates will depend on the data and our assessment of emerging inflation pressures. Our clear goal is to contain inflation, and in doing so, help ensure that the economic expansion can be sustained for as long as possible. Thanks very much.
There'll be some people with a mortgage that have never had a mortgage, say 5 years ago, haven't been through an interest rate cycle. There'll be some people who might be considering a mortgage and suddenly realizing interest rates can actually move, and they might be a lot more nervous about what the implications are. And so we're talking about very prudent behavior might be coming in. They might be watching what develops. And so we might see the housing market slow down even more rapidly than it has in the past 2 cycles.
There isn't a central bank in the world that I know, and it's certainly true of this one, that doesn't think about the real economy, about the exchange rate, about unemployment when it's looking at monetary policy settings. And a big reason for the strength of the recovery is the fact that we lowered interest rates to their lowest in 50 years. I mean, this is the first essential significant tightening phase for 5 years in this economy. So the Reserve Bank, I think, along with some very prudent government policy, particularly around fiscal policy, I think played an important role in getting this recovery underway. What we want to do is to contain inflation pressures so that we don't have excessive tightening, we don't lose competitiveness, and we want to contain those inflation pressures so we can sustain this recovery. We want it to go for as long as we possibly can. This recovery is becoming increasingly broad-based. It's a strong recovery. It's got many factors driving it, and I talked about those in my opening comments. One thing that does stop recoveries in small open economies is inflation getting out of control. Because it starts to undermine the growth in real income, it starts to undermine the competitiveness of the economy. And that's the thing that we want to avoid. We want to move early, we want to contain inflation expectations, and we want this recovery to go for as long as possible.